I'm Bambi Francisco, and I'm speaking with Sharon Weinbar. She's a managing director at Scale Venture Partners. Sharon, thanks for joining me.
Thanks, Bambi.
2009 was a brutal year for venture capitalists, the venture capital industry, except it seems like things have changed a lot over the past 6 months. I mean, for Scale Ventures, you've seen a couple of exits.
Yeah, we had 2 big exits in November. Adobe Systems bought Omniture for $1.8 billion, and Cisco bought ScanSafe for $183 billion. So it was nice to be able to send money back to the LPs. They were both really strong, positive exits for us.
That's good. Well, congratulations on that. And then you've also made an investment, $16 million in Hubspot. At least that was the total round for Hubspot. And recently, Zynga raised $180 million. So it seems like people are, putting money to work, and so we're going into 2010 in a lot better shape, I think, than when we were going into 2009. What's your assessment for 2010?
So I think 2010 will see a pretty active year. When you look at the big picture in venture capital fundraising and venture capital investing, so how much we raise from LPs, we as an industry, and how much gets invested in startups, it tracks pretty much one-to-one. And in 2009, the amount of money that we raised from LPs as an industry and that we wired to startups fell dramatically. So it went from somewhere between $28 and $30 billion to about $15 billion. So so it fell in half, and startups felt that money was much tighter. And that's probably about the right size for the industry. Because when you look at venture capital investing as a percent of GDP, this year it'll be at about 0.5% of GDP is the amount invested, which is kind of the long-term typical average up until the bubble. In bubble 1.0, in the 99-2000 timeframe, it went over 1%. It got way ahead of itself.
Like
too much money.
Or something
yeah, 2% in 2000. So money flooded the system. And then in crash 1.0, it came down a little bit, but it never really right-sized relative to GDP to what it was through the kind of golden days of venture capital in the mid-80s to mid-90s. Now it feels like it's about the right amount. So you can get, good companies can get funded, can get plenty of capital, but all the little Me Too companies don't get funded. So leaving the competitive playing field more open to the good companies to actually get traction. So that's kind of big picture in venture capital fundraising. The great thing that's really exciting about being a VC and being involved with startups is companies grew really the good companies grew really nicely in 2009, and I think that's got VCs feeling bullish again and wanting to invest. So you had companies like HubSpot that we invested in, software as a service company, revenue more than tripled this year. That's really hard to do in a subscription business, but it's a great sign that they've invented something of real value to their customers, and so, and that's true across a lot of different segments where there are products and services that are growing really fast, even while the economy, was continuing to decline. So the secular trends that the startup companies are going on are outpacing the cyclical decline in the economy, and again, that makes you feel
you'd hope
positive.
So, especially with these such young companies, they should be on this growth track, right?
Right. And sometimes, some businesses, when they're cyclical and they're small and fragile, they just get, venture capital smackdown. All the companies that were selling, big ticket enterprise things got body slammed to the ground in Q1 of 2009 when every CFO in America just said, I'm not signing any POs for anything. Doesn't matter how much we need it. I'm not buying it.
You have some pretty good companies in your portfolio, Waterfront, Media, Merchant Circle, Reply. I mean, what % of your companies in Scale do you expect to file for an IPO in 2010? Which ones are likely to
okay, so we always have to be really careful, and I know you understand that, but I think the thing that's exciting is we have a bunch of companies that are big and of the scale and growth characteristics that be interesting to be public companies, Waterfront Media being one of them, a company called Mblocks, which is in the mobile payment space, Reply.com, which is a marketplace for performance media. Merchant Circle may be a little bit small to be an IPO candidate, but it's more than doubling year on year, profitable in the huge local merchant advertising space that's over $100 billion market that's very lightly penetrated online. So
You have some.
We have a bunch of companies that are more than doubling year on year, profitable.
Well, talk about that. Let's talk about the financials that a company has to have. You and I were speaking earlier about ReachLocal, which is generating, what did you say?
Yeah, so ReachLocal did $143 million. They just filed their S1 yesterday. Yeah. We're not an investor in the company, but it's a space that we're interested in. And I have two other companies in the local business advertising space. They did $143 million in the first 3 quarters of this year, had negative earnings except for a one-time asset sale, so that put them technically operating income positive. So they have pretty nice growth characteristics, but not yet profitable, even though they have very large revenues. So that one, I would say, it'll be interesting to see what the receptivity of the public market is to that. Most of the companies that have gone public in 2009, and it's been not a bumper crop by any stretch of the imagination, but there have been about 20 tech IPOs this year, up dramatically from last year. Last year is the worst IPO year ever.
2008.
2008, yeah, the worst year in venture capital history.
So a company could have a couple $100 million or $100 million in revenue and not be profitable in 2010 and still go public.
Well, that's the big question mark.
What's the
all the companies that have gone public this year are already profitable, and they're valued on next year's EBITDA. That's the metric that everybody's looking for, and it's actually, when you look at tech companies across a huge range of industries, they're all valued almost the same, which is somewhere between about 9.5 and 12.5 times 2010 EBITDA. So, so they might be making $20 or $30 million in EBITDA projected next year, and then they're then you multiply it by 10 or 12, and that's the market cap.
Well, that's interesting that you and I were talking earlier too about fast growth companies and whether 9.5 times EBITDA is a fast growing company, or if the market is really, if there's a strong appetite for hyper growth companies in the 18 to 20 times EBITDA range, whether that bodes well for the private companies.
Right. So in the public markets, there are some very strong growers. There are only a handful. So first thing, there are only a handful of strong growers in the public market, period. When you look at overall NASDAQ tech, there's 1,800 tech companies public on NASDAQ. There are about 25 companies that have a revenue growth line over 20%. So what's considered a growth stock on NASDAQ these days is, it is a lot lower than what our expectation in Silicon Valley typically is. So most of those, so that's what the public comps are also saying, is that those companies that have 20% growth have EBITDA multiples, in the range of 12 times next year. As you look at a couple of companies that have much higher revenue and earnings growth, some notable ones, maybe WebMD or Mercado Libre, which is the eBay of South America, Alibaba, a couple of other, international companies that have very strong growth and earnings growth characteristics. They're trading at higher multiples. So the big question is, and the companies that have gone public this year have had revenue growth in, say, the 30 to maybe 50% range, but often kind of in that 25 to 35% range. So, and that's making them growth heroes on Wall Street, because all the existing public companies are going less than 20%. As you start to get some companies going public that have growth rates over 50%, what we're hoping is that public stock buyers lean into the valuation a little bit and give them earnings multiples that are higher than what the existing companies have.
But overall, it sounds like your assessment for 2010 is that it's going to be a good year for
people
exits.
People are saying, I hate to use that kind of, investment bankers are telling me that there could be 100 tech IPOs next year.
Wow. Well, that's a great way to end this segment of the first part of the interview. You're going to stick around. We're going to talk a little bit more about this. Thanks, Sharon. I've been speaking with Sharon Warnbayer. She is the managing director at Scale Venture Partners. I'm Bambi Francisco.